Hey, welcome back, guys. It's Dan from Pekoe Mortgages, and we're doing another weekly mortgage roundup for this week. So I'm just going to jump into it really quickly and run through all of the headlines and what you can expect maybe in the next few weeks. All right, so for today, the number one thing here is that next week we have the Bank of Canada making their announcement on interest rates, and there was a recent article that came out in the Globe and Mail, and it basically states the countdown begins for variable rate mortgages. And as you might know, variable rates are tied to that Bank of Canada overnight lending rate. So that prime rate announcement, if it goes up, then we're going to see likely those variable rates go up as well. So if you have a variable rate mortgage, you're going to want to keep an eye out on this. And I'll be doing a video after the announcement, so we'll break down what happens during that. But basically here, the market's expecting about a 2-point increase over the next couple of years, so going into 2023. So what does that mean? 2% higher than what we're currently seeing on the variable rate side. And before you guys panic, don't worry, I've done a little bit of the math for you, and we're going to jump into that in the next screen. This here is an exercise I actually did for a client of mine who recently had closed, and they reached out saying, hey, maybe we should be locking in. We've seen a lot of stuff in the news about fixed rate mortgages and variable rate going up, so should we lock into a fix before it goes up? In this situation, I'm going to just break down, this is a real world scenario here. Clients have a 1.35% variable. They bought a property with a mortgage just over $785,000. The interest rate that they have, like I said, is 1.35. They have an option to lock it in at 3.19%. So you can see that's considerably higher. So here's my strategy, and this is something I've talked about in some other episodes, where basically you set your variable rate payments as if it was a fixed rate today. So that difference here, right now they're paying about $3,000. So let's assume that you start making those payments at $3,800, which happens to be your fixed mortgage payment every month at 3.19% for that same $785,000. So what happens? You're essentially self-insuring against those interest rate increases. This here, there's a couple assumptions. One assumption is both payments are the same, so fixed and variable. The other one is it's a 25-year amortization. And we do some increases. So the first one here, a 0.25% increase annually. So that's on the variable side. So you can expect one rate increase annually. Now we know in the other screen, they were saying about 2% in the next couple of years. So we're going to get to that. But check this out. Your variable rate option wins by over $52,000. That's money in your pocket. The other scenario here is we increase it by 50 basis points. So 0.5% every year. So at the end of 5 years, you've got a 2.5% increase on your variable rate mortgage. But guess what? You're still ahead $34,000. So variable wins here. Next scenario I did was an increase of 75 basis points or 0.75%. Guess what? Variable still winning, $16,000. There's your winner. Where it actually kind of breaks even, or where fixed makes sense, is when you have an annual interest rate increase of 1% on your variable, right? So that becomes a winner for the fixed rate. But are you really willing to pay that premium, that basically $800 premium, just for the possibility that 1% a year, that's going to be 5% increase on your variable over 5 years? Do you think that's going to happen? I don't think so. But again, you know, that's sort of the premium you pay if you want to go and lock in a rate today. So this is just a quick little exercise I did for one of the clients, but I wanted to share it with you guys today. Anyway, let's move on. What else happened? Let's check out the bond market. So bond yield today. Today being, the end of the week, February 24th, we've got yesterday's numbers. 1.74% is. So basically, we had a high and then it dropped down a little bit at the end of the week. That's also indicative here. At the 5-year, we had 1.72. That's when we entered the week. We closed the week a little bit higher, but it's still trending up. What does that mean? Fixed rates. I've seen fixed rates, especially on the alternative lending side. So if you guys are looking for an alternative mortgage, just keep in mind those rates are starting to move up too. No surprise there. What else is happening in the rest of the world? Well, we've got a bunch of stuff going on. I'm saying meanwhile in the US, but I also mean, globally. So this is interesting. This comes out of Time magazine. Mortgage rates rose again this week to 4.08%. Here's a big thing, the Russian invasion of Ukraine. So that's going to affect a lot of things over here, guys. Anything from fuel to the rate of mortgages to the stock market. Basically, it boils down to uncertainty. There's a correlation there with risk. So keep that in mind. We got to see how this unfolds in the next weeks and months. Hopefully a resolution can be found pretty quickly. Overall, guys, that's kind of what's going on here. Interest rates, no surprise in the US, they go up when ours goes up, or actually it's vice versa. Usually we follow their market, but again, it's going up. And also refinances have been down by about 45% this year. So that's in the US. A lot of mortgage lenders are cutting back on employment, so they're starting to tighten their belts there. Anyway, guys, that's what I got today. No real surprises on the front. Keep an eye next week on that Bank of Canada rate announcement. Circle back here because I'm going to talk about it and let you guys know what I think. Again, thanks for watching. Comment, like, subscribe, and I'll catch you on the next video. Take care.